If you looked at the chart of the best-performing stocks over the last 2 decades, you'd probably expect to see tech companies like Apple or Amazon at the top. But there's a beast in the market that has outrun giants and created a legion of millionaire investors by selling just one thing: energy in a can. Today we're going to take a deep dive, a real deep dive, into the investment case for Monster Beverage Corp., ticker MNST. We're not just going to talk about the product, but about the cash-generating machine this company has become. We'll look at the strategy behind the partnership with Coca-Cola, understand the economic moat that protects the company, dissect the regulatory risks, and figure out how they're handling management succession and entering the alcohol market. If you're looking for solid analysis and not just hot tips, go ahead and hit that like button and subscribe. Let's dissect Monster. Business strategy and the Coca-Cola system. To understand Monster today, we need to realize it's no longer just a beverage maker, it's a marketing and innovation platform hooked up to the most powerful distribution system in the world. Even though Monster didn't invent energy drinks, Red Bull arrived 15 years earlier. Monster cemented its position through relentless innovation. But the big game changer, the secret sauce of this thesis, happened in 2015. That year, the long-term partnership with Coca-Cola kicked in. Monster essentially became the exclusive energy drink option within the Coca-Cola system. What does that mean in practice? 1. Reach. Monster gained immediate access to a global distribution network that its competitors, except Pepsi, can't match. 2. Focus. Coca-Cola transferred its energy drinks to Monster, and Monster transferred its juices and sodas to Coca-Cola. Full focus on the core business. And the current strategy is what we call the dual strategy. On one side, we have the premium positioning, the original Monster brand, sold in modern retail and convenience stores. On the other, the attack on emerging markets and consumers with less purchasing power. This is where the Predator and Fury brands come in. The idea is to use Coca-Cola's reach in traditional trade, those small neighborhood shops in Latin America, Asia, and Africa, to get these cheaper products into the hands of people who can't afford a traditional Monster can. This is crucial because the energy drink category offers much more attractive volume expansion than traditional sodas. Competitive advantage, moat, and brand strength. Now let's talk about the economic moat. Monster has what Morningstar classifies as a narrow competitive advantage, narrow moat. Why narrow and not wide? We'll get there, but first, what supports this moat? Basically 2 pillars: intangible assets and distribution network. First, the brand. Monster has an almost tribal connection with its consumers. Sponsorships in NASCAR, MotoGP, UFC, this keeps the brand top of mind. And the numbers prove it. Look at this global data for 2024. Monster has about 17% volume share, compared to 12% for Red Bull GmbH. But if we look at North America, Monster's backyard, the dominance is brutal. 46% share versus Red Bull's 20%. This brings us to an interesting point about pricing. Monster doesn't disclose exact retail prices, but its average gross margins of 55% over the last 5 years are comparable to Coca-Cola's 60% and Pepsi's 54%. This indicates that consumers are willing to pay a premium for the brand. They don't need to compete on price. The second pillar is the already mentioned Coca-Cola distribution. Since the 2015 agreement, Monster has pulled ahead of Red Bull in the United States and closed the gap in Europe. Red Bull, being a family-owned and more conservative company, has lost ground, dropping from 15% in 2016 to 12% globally in 2024. However, not everything is perfect. Monster doesn't have a cost advantage. It's small compared to Pepsi and Coca-Cola. It buys aluminum cans and ingredients from the same places as these giants, but with less bargaining power. That's why its competitive advantage comes from brand and distribution, not low costs. Innovation and product portfolio. Many bears, pessimists, say all energy drinks are the same. Monster proves them wrong with its innovation pipeline. In the last 20 years, they've added 10 product lines. The absolute standout here is the Ultra line and the zero sugar options. Monster noticed early on the consumer shift towards healthier choices. While traditional soda suffers, sugar-free energy drinks grow. We also have Monster Super Fuel, focused on performance with magnesium. Juice Monster, mixed with juice. attracting those who don't like the medicine taste of some energy drinks. Java Monster. Coffee with milk and energy. Rehab. Non-carbonated teas. They are planning to launch the FLRT brand, specifically aimed at women, a demographic that historically consumes fewer energy drinks than men. This expands the total addressable market, TAM. This ability to innovate and keep consumers engaged is what sets Monster apart from being just a one-product company. The risks, the bear's view. As investors, we need to be skeptical. What could go wrong? What's the bear's argument? 1. Regulatory risk. This is the biggest ghost. Restrictions on caffeine content, bans on marketing to minors, sugar taxes. This is a constant threat in North America and Western Europe. 2. Competition from giants. PepsiCo isn't sitting still. They bought Rockstar, invested in Celsius. Keurig Dr. Pepper is also making moves. These companies have deep pockets and their own distribution networks. 3. Niche dependence. Monster is 90% energy drinks. If tomorrow a definitive study comes out linking energy drinks to a serious health problem, the company suffers much more than Coca-Cola, which is diversified. 4. Alcohol execution, the acquisition of craft brewery. Keurig in 2022 has been disappointing so far. Operating losses, write-downs. It's a new tough market, with competitors like AB InBev. So far, the beast hasn't roared in the alcohol market. Financial strength and capital allocation. If risks exist, Monster's defense is its balance sheet. The company is a financial fortress. In September 2025, they had $2.5 billion in cash and short-term investments. Debt, zero, nothing. Cash generation is strong. Free cash flow, FCF, averages 19% of sales. The projection is for this to rise to 24% in the next decade as supply chain issues, aluminum cans, freight, normalize and cost inflation decreases. And what do they do with that money? 1. No dividends. They've never paid them and they don't plan to. 2. Share buybacks. They are aggressive here. They returned $5 billion between 2014 and 2023, plus $3.7 billion in 2024 via a public offer. This increases the stake of those who hold the stock. 3. Acquisitions. They bought flavor supplier AFF, strategic vertical integration, Keurig, beer, and in 2023, Bang Energy, and its facilities, for $360 million. The Bang acquisition is interesting for capturing the lifestyle fitness audience, but it needs to be integrated into the Coca-Cola system to be profitable. Conclusion and future outlook. To wrap up our thesis, Monster Beverage is in a moment of transition, but a transition of strength. Rodney Sachs and Hilton Schlossberg, the architects of this empire, are in their 70s. Sachs left day-to-day management in 2025. Schlossberg is now the sole CEO. Succession planning is a risk, but also a natural evolution. We have a company with projected revenue growth in the high single digits, operating margins expected to expand to 33% by 2034, a distribution partnership that runs until at least 2035, with renewal risk further down the line. The bull case is clear. The world wants more energy, wants sugar-free options, and emerging markets are still waking up to Monster. If the company can replicate the success it had in the United States in Asia and Latin America, growth is guaranteed. On the other hand, if regulations get tighter, or Pepsi makes a strong move, growth could slow down. Based on operational excellence, an impeccable balance sheet, and brand strength, Monster seems poised to continue being one of the best consumer stocks on the market. But, as always, do your own due diligence. What do you think? Is Monster still the king of energy drinks, or will the competition keep it up at night? Let us know in the comments. Don't forget to subscribe for more deep dives. See you next time.